Welcome back, everybody, to another episode of Cash Flow with JVH. Today, we're going to talk about the Iron Condor strategy. It's a little bit complex, but I think you can handle it. We'll step through all of the details of the strategy in this video. Just a reminder, if you haven't already, please give this video a nice thumbs up. Also, be sure to subscribe to the channel and share my channel and videos out on your social media streams and get my name out there and help me spread these videos. So the Iron Condor strategy. This is actually a great strategy for anybody that has an account like Robinhood, and it's a smaller account, so like under $5,000. It's a very complex strategy, but we're going to dive into the details of the strategy itself in this video. It's also a strategy that can give you a high probability of profit if managed and executed appropriately. So the Iron Condor strategy is actually the combination of a call credit spread and a put credit spread executed at the same time on the same order. So it is a four-legged spread. It is also a neutral strategy which benefits from theta decay, and you want the stock price to stay as flat as possible. If you are not familiar with what a credit spread is, either for a call credit spread or a put credit spread, I highly recommend you get familiar with those strategies. I will put a link to my video up top so you can easily link to that and see what these credit spread strategies entail. Again, this is a very complex strategy, so you have to understand what credit spreads are and the intertwining workings of those before you can actually understand the Iron Condor. So as I mentioned, the Iron Condor is a four-leg strategy. You want to make sure that you purchase all four legs in the same order. So for anybody using Robinhood, this would make sure that you are on options trading level 3. Otherwise, you'll have to open these legs separately, and that makes it very complicated to open and close at the same time. And you could run into some other complications in doing it, but you want to make sure that these four legs are all in the same order. Let's take a look at the four legs themselves. So leg number 1, you want to sell an out-of-the-money call. My personal preference is to find a strike price for the call that I'm looking to sell with a delta of about 0.16. This roughly translates, not exactly, but roughly translates into an 84% probability of profit. But again, it's not exact, but it's just a general rule I look for, or I use to look for a delta around 0.16 for the call I'm looking to sell. The second leg is you want to buy an out-of-the-money call. Now, both the calls the strike price needs to be greater than the current trading price, and the call that you buy needs to be slightly higher than the call that you're looking to sell. So these first two legs, if you're familiar with credit spreads, you'll recognize that this is actually a call credit spread strategy. In order to make this an Iron Condor strategy, we're going to add the second set of legs, and that is the leg 3 is the selling of the out-of-the-money put. Again, this is a put that you need the strike price to be lower than the current trading price of the underlying stock. And again, I look for a delta of about negative 0.16. And then the fourth leg, you need to buy an out-of-the-money put. And again, this put that you're buying needs to be slightly lower than the put that you're actually selling. This then turns into a put credit spread, and the combination of a call credit spread and a put credit spread makes up what is known as the Iron Condor strategy. So let's dig a little bit deeper into this strategy and see how it's made up. Let's take a look at what makes up the Iron Condor, and again, it's the call credit spread plus the put credit spread on the same order. The max gain for a call credit spread is if the stock price at time of expiration is below the short strike price, and then a put credit spread is profitable if the stock price at time of expiration is above the short strike price. In an Iron Condor, you're going to be profitable at your max gain when the stock price at expiration is between the short call and the short put. The max loss for the Iron Condor strategy is if the stock price at expiration is above your long call or below your long put. Again, just like any credit spread strategy, the long legs are there to hedge losses on the short legs. Let's look at an example of how the Iron Condor strategy might work with an example stock. So for this example, we're going to use the made-up stock symbol JVH, appropriately named. And we're going to say that right now JVH is trading for $30. Now, when I personally look for stocks to trade with the Iron Condor strategy, I look for stocks that, again, are going to be remaining flat. I look for expirations anywhere between 30 and 60 days out, so it has plenty of room to run, and theta decay can take its time and start eliminating itself. I also look for stocks that are pretty strong. I also look for stocks that have a lot of volume and open interest in the options themselves. I also look for stocks that have options where the bid-ask spread is pretty tight so that it's easy to open a position and close a position if I wanted to. So in this example, the first portion of the Iron Condor is the call credit spread. And JVH is trading at about $30. I don't expect JVH to trade any higher than $32 over the next 30 days between now and expiration. I also don't expect it to go below $28. So for this first portion, I'm going to sell a call at $32 strike price, and I'm going to get a credit of $150. But then I'm also going to buy a $34 strike price call, and it's going to cost me $70. So my net credit will be $80. And if we take a look at the break-even point, that's $32.80. So my max loss for this, because it's a $2 strike differential, that's $200, minus the $80 credit, my max loss is going to be $120. So my break-even is actually your net is your short strike price plus the net credit. So in this case, $32 for the call strike price plus the $80 credit gives you a break even of $32.80. My max loss would occur around $34 because if you take the $34 call that I am buying, and if it goes above this, if the stock price goes above $34, my max loss then is $40. Yes, I do realize that my graph is a little bit off as far as where the lines match up, but you get the idea. So as I mentioned, I don't think the JVH stock price is going to go above $32, but we want to hedge our bets and we want to make sure that we minimize our risk, our max loss, but we also want to try to increase our max gain. So this becomes the other side of the Iron Condor, and this is the put credit spread portion. So again, I don't think it's going to drop below $28 over the next 30 days before expiration. So we're going to sell a $28 put and collect $150 premium credit. But we're also going to buy a $26 put and pay $70, which gives us another net credit of $180, thus doubling our credit to $160 credit. Breaking down what this graph and chart looks like, right? So the center part of this graph is called the body. The other part on the left, the other part that's green, where you start to see your max gains start to reduce as it gets closer to the lower strike price or the lower short strike price. That's called the put wing, and then on the opposite side, it's called the call wing. So I'm sure the first question you're probably asking yourself is, this is great, we've doubled our max gain, but did this also double our max loss? And the answer is no. And the reason for that is, before expiration, you can only bust one side or one wing of this Iron Condor. You can't bust both wings at the same time. And that's because the stock price can only be on one side or the other or in the middle. The stock price can't be two different prices at the exact same time. So for example, if JVH goes to $36 and you bust your call wing, your max loss is $120 on the call wing, but you still get the credit, the $80 credit from your put wing, so your actual max loss is only $40. And then vice versa, if JVH falls below $24 and you bust your put wing, you lose the $120, which is your max loss on the put wing, but you still keep your $80 credit on the call wing, and thus your max loss at that stage is also only $40. The other benefit to this is, by putting both strategies together, is your break evens will also move out as you execute on this strategy. So in this case, your break even is, if on the put side is $26.40, your break even for the call side is $33.60, giving you anything in between, you're going to hit a profit. So is there a catch? Well, yes, there's a slight catch. So for a put credit spread, you basically are rooting for the stock not to go below a certain point, right? The higher it goes, that's great. Same with a call credit spread. You're rooting for it not to go up past a certain point, but if it goes below a certain point, it doesn't matter if it's, $24 or $0, you still are going to gain. The thing with the Iron Condors are, you can't root for it to not go up and you can't root for it not to go down. You need it to stay as flat as possible within that body of your Iron Condor. Credit spreads are less bound, right? We talked a little bit about that, but Iron Condors do have upper and lower break-even points that you need to keep an eye on. The great things about Iron Condors versus credit spreads is you have a higher max gain, a lower max loss, you have better break-even points, but you do have a lower potential for profit. You could increase your probability of profit by widening your body, making the body of your Iron Condor bigger. You do reduce your max gain, and you also do increase your max loss. Here are a few things to consider before executing on an Iron Condor strategy. Again, measure yourself and your risk portfolio, your risk profile. Do what you feel is most comfortable. I am just here providing explanations and education on the Iron Condor strategy. You execute as you feel fit and that fits your comfort level and risk profile. The first thing of consideration is take profits when you can. Personally, as soon as my profits hit 50%, I try to close out my position. I don't get greedy. I don't try to milk every single penny. 50% profit I am happy with. Again, you pick whatever percentage you are happy with. If you want to wait till expiration, that's up to you. I try to take profits as soon as I can, and again, that's around 50%. The second piece of advice that I would give, or suggestion of consideration, would be keep your wings short. The wider your wings means more collateral you're going to put up front, and which also equates to a more max loss that you potentially see. The third piece of consideration is pick strong stocks that stay flat, right? Really large growth stocks that continue to see growth, but it's a slow moving engine, right? It's really difficult to really turn the trajectory of the way the stock is trending. Find ones that are pretty much consistently flat, at least consistently flat for 30 days of time, or 60 days depending on what kind of expiration length you decide to choose. And then lastly, last piece of consideration is try to find stocks and options contracts that have smaller bid-ask spreads, right? So the smaller or closer together the bid and the ask are, which is your bid-ask spread, the more likely it is and more probable it is that your ability to open an Iron Condor and close an Iron Condor strategy, the more likely it is that that will happen. So try to find options with bid-ask spreads that are pretty narrow. thank you so much for watching. I really hope you learned something from this. I know it was a really tough strategy to get through. It's pretty complex with so many moving pieces and parts, but I hope you learned something. Really appreciate everybody watching this video. Again, give me a thumbs up. Share the videos out to do your different social media platforms, and also be sure to subscribe to the channel. To get more information about my channel and find ways that you can help support the channel, please check the description below. I provide a referral link to my Robinhood account, as well as an invite to our Discord channel or Discord group, and also provide my Venmo account information if you'd like to send me a small donation. Again, really glad everybody enjoyed the video. Happy trading.